Good evening, ladies and gentlemen, and welcome along to this IC Markets webinar, The Ladder to Success, Powerful Candlestick Patterns. My name's Chloe, I'm with Trade with Precision, bringing you this webinar alongside IC Markets. Before we get started, I would just like to give you an opportunity to, first of all, do a sound check. So if you could just post in the questions box that you can hear me okay and that you can see my screen okay, that would be fantastic. And also I would like to give you an opportunity to read this next slide, which is the risk disclaimer slide. So I'm just going to give you a couple of moments to read through this slide, make sure you agree with everything therein, and then we can get started properly with the webinar. Fantastic. Thanks, guys, for all the feedback. Wonderful. Good to hear. All right. So, as I said, my name is Chloe. I'm a trader based in London, and this webinar is all about candlestick patterns. So, before we get started, actually, I just want to also let you know I do like to keep these sessions as interactive as possible. Obviously, this is for your benefit. So, please do ask questions as we go through. I'll do my best. There's a lot of people in the room today with us. So I'll do my best to get through as many questions as I possibly can, but if you do have any burning questions, please feel free to put them in the questions box. And as I say, I'll take a look and see if I can get through them all in the time that we have. So my name's Chloe. I am, as I said, a trader from London. I am a predominantly technical trader and trend-based trader. So I trade everything from Forex to commodities, indices, and other leverage markets as well. And I focus my attention on trend trading. So the strategies that I use are predominantly trend-based strategies and technical. So let me just keep an eye on the questions. Fantastic. Thanks, everyone. Thanks for the feedback. All right. So the agenda for today, then. We are going to be reviewing the importance of using candlesticks. We're going to be talking about how to identify trends and patterns in candlesticks. And we are going to look at finding entries and exits using candlesticks. So to start off with then, the importance of using candlesticks. In fact, what we're going to do is we're going to spend the majority of this webinar actually on the web-based platform. So bear with me while I bring that up for you. So what we're looking at here is a completely blank screen. I don't have any indicators on my chart. I just want to look purely at the candlesticks. This is a webinar all about candlesticks. And just to show you the importance of candlesticks, I think it's really important that we remove all of the indicators from the charts. If, you know, those of you who are already trading and experienced traders, presumably you may be using indicators in your strategies and with your trading, but in order to strip things right back, I like to remove all indicators and everything from my charts and just look at the candlesticks. Now, why are the candlesticks so important? Well, it's because the candlestick is purely the printed information of the market. The candlestick tells us the current price of the market, and it tells us in any given period of time what the price did over the course of that period of time. So for example, here I've got a chart of gold up, and this is the daily time frame. So each of these candlesticks represents one day, and each of these candlesticks tells me what happened during that one day. Where did the price open at the beginning of the day? What happened to the price throughout the day? What was the high of the day? What was the low of the day? And eventually, what price did the candle close at? What price did the day finish at? And all of that information is very, very important. Over and above any indicators, price is key. Indicators are based on price. So price has to have happened already in order for an indicator to have happened, to be calculated. So for example, if you're using a moving average, the 50 moving average, for example, would be the average of the price of the last 50 candles, but those 50 candles have to have happened already for that moving average calculation to take place. So the price is really the rawest, purest form of analysis that we can do. The candlesticks show us the pure price action on the chart, and that's why it's so important. Now, why is it so important for us to know what happened over any given period of time? Well, it shows us who is in control of the market. The market is built up of buyers and sellers, and in order to make informed decisions about whether we are going to buy a particular market or whether we're going to sell a particular market or whether in fact we're going to do nothing with a particular market, we need to know who is in control of that market. Is it the buyers or is it the sellers that are in control of the market? Because what we want to be doing is we want to be going with the overall market flow. The easiest money, in my humble opinion, to be made is with the overall market flow. I don't want to be surfing against the tide. I want to be surfing with the tide in the direction of those waves. So it's very important for us to analyze and assess who is in control of the market, and the candlesticks can actually show us who is in control of the market on any time frame in any given period of time. So I just happen to be looking at a daily time frame here, and each of these candlesticks is going to tell me who is in control of the market every single day. But if I were to change the time frame to, for example, a 15-minute time frame, then each of those candles would tell me who's in control of that 15-minute period that I might be interested in. So looking at the daily time frame here, once I have been able to ascertain who's in control of the market, I can also look out for candlestick patterns which might give me an indication of where the market might go next. Now, as a trader, I need to know where the market might go next. The market is random to a certain extent, and no one can predict with 100% certainty where the market is definitely going to go next. But we can make an informed decision based on what we know about the market's historical data, and we can make an informed decision based on our analysis of the candlestick patterns and the trend and the price action in order to work out what is most likely to happen next. It's never what is definitely going to happen next, but what is most likely to happen next, and that way we can skew the market in our favor. We give ourselves an edge, and therefore as a trader we can over the course of a period of time have a higher probability of success. So hopefully that has given you an idea of why it is so important that we discuss candlesticks and that we use candlesticks in our analysis for our trading. How do we do that? So how do we use candlesticks to identify trends and patterns? Well, let me just go back to basics very, very briefly. I'm going to just draw on the chart. So a candlestick tells us what the opening price of a period of time is. So let's just say we're talking about a day. What's the opening price of the day? And then price will move up and it will move down and it will move up and down over the course of the day. And then there will be a closing price. So price will open at a certain level, price will move up and down over the course of the day, and it will close at a certain level. Now the candlestick is purely that information encapsulated in one candlestick. So that particular candlestick would look a little bit, and you must excuse my poor drawing, it will look a little bit like that. So you've got the open, the high, the low, and the close. And the candlestick, because it opened over here higher and it closed lower, that will be coloured in red. So that would be what we would call a bearish candlestick or a seller candlestick. That would show us that on this particular day, the sellers were in control of the market. Now, on its own, this might not mean much, but once we can start to build a picture, then we can start to make it mean more for us. So the candlestick shows us who is in control of the market. Is it the buyers and the sellers? Very, very simply, the red candlesticks show price opening higher and closing lower. So price has been pushed down over that period of time. The sellers have been in control of the market over that period of time. The green candlesticks show price opening lower and closing higher than they opened, which means that price went up over that period of time, and it was the buyers that were in control of the market on that particular day or in that period of time that we're looking at. So we also have various different shapes of candlesticks. Now, I don't have time in 1 hour to teach you every single candlestick pattern that there is out there. I'm going to cover some of the ones that I believe are the most important, and certainly the ones that I find the most useful for my trading. So we have bullish candlesticks and we have bullish candlestick patterns. So a candlestick would be just an individual candlestick, and a candlestick pattern would be a series of 2 or more candlesticks. And of course we have bearish candlesticks, bearish candlestick patterns, and we also have continuation or indecision candlesticks as well. So let's start with a bullish candlestick pattern, or a bullish candlestick, which is a hammer. So there's an example of a hammer candlestick right here, and in fact another one right here. So the reason that that is bullish is if we take a larger look at this. So what has happened here, it doesn't really matter the color of the candlestick. Okay, so whether it's green in color or whether it's red in color, that doesn't matter. What's important is the fact that the candlestick opened near the top and price traded all the way down to a tip at the bottom, and then it closed up again near the top. So price has come down from a high, it's traded all the way down, it's tested down here, price has dipped its toe in the water down here, and then the buyers have pushed price all the way back up. So the sellers took control, pushed the price down, and then the buyers took over, pushed the price back up. And the closing price is high, which means the buyers have taken over. The buyers are in control of the market at that particular point in time. So that is a bullish candlestick. So that's called a hammer. To be honest with you, the names of the candlesticks aren't all that important. What's important is the message behind the candlestick. So some people might call this a hammer. There would also be a dragonfly doji, which would be where the open and close are pretty much in the same place, but it's still the same information that is being represented here. you know, there are other names for these things, and there are some traders that don't even call them by a particular name. They just call it a bullish candlestick. So the name of the candlestick is not important. What's behind the candlestick, the sentiment behind the candlestick, is important. So this is a bullish candlestick. Now, of course, it depends on the context as well, and we'll build this up, the context, as we go through the webinar. We can also have this can also be a bearish candlestick, and this is what I mean about context. So generally, a hammer will appear where price has come down, and then price goes potentially back up. So for example, this one that we're looking at here, price has come down from up here all the way down to the tip, and then it goes back up. Over here, this one here, price has come down from this high all the way down to the bottom, and price has come back up. So over on the left-hand side of the candlestick, price will be traveling downwards, and then we're looking for this hammer at the bottom of that move down, which may signify the beginning of a move back up. If we see this same shaped candle after price has gone up, so we could see this same shaped candle after price has come up, it can be a bearish signal as well. Why is this? Well, because let's go back to what this is saying about price action. Price is opening near the high. The sellers are pushing the price all the way down to the low. The buyers are pushing price up high, but they're failing to get much higher than where the price started. And if price then turns around and goes down, and the sellers are able to overcome this previous low that was forged by this particular candlestick, then that can be a bearish sign as well. So this particular pattern wouldn't be called a hammer. Some people call this a hanging man pattern. So it's the same candlestick shape, but as a result of a move up, then we see the candlestick, and then the result is a move down. And let me get rid of some of these scribbles. Okay, so the kind of opposite candlestick to that would be a shooting star, or what some people call a shooting star, which would be a small body near the bottom of the candle. Again, it doesn't matter if it's green or red, and a long tail at the top. So in terms of price action, what's happened here, it's opened near the bottom. The buyers have pushed price all the way up to the top of the candle. They've tested this price up here, failed to get through that price, and then the sellers have come back in, taken control, and pushed price all the way back down to near the bottom of the candle. Therefore, the sellers have ended this candle in charge. It's a potentially bearish sign, and of course, we would need price action to be coming up from below. Then we would see this candle at the top, followed by a return to the downside of price action. So an example of this, let me see if I can find an example of this. Well, there's one right here. So that would be a shooting star. One right here, another shooting star. So we've got price coming from below, going all the way up, and then turning around. The sellers are taking charge, and price continues downwards. And again, here we've got price coming from below, going all the way up, sellers taking charge, and price moving downwards. You'll have to excuse me if I do get a bit of a croaky voice. I have a I have a little toddler who is in nursery, and I'm sure those of you who have kids know the germs that they bring home from nursery in their first year or two are constant. So I've constantly got a cough or a cold or a sore throat or whatever it happens to be that week that gets brought home. So you'll have to excuse my croaky voice. Sorry about that. Okay, so the next kind of candlestick pattern that I want to cover, I'm focusing mainly on the bullish and bearish candlestick patterns at the moment, and it'll become clear why once we get towards looking at entries and exits. So I want to talk about candlestick patterns that involve more than one candlestick. So first of all, bullish engulfing. This is a bullish signal, and it's a reversal candlestick pattern. So price will have come down, and then we're looking for a reversal. So we would have a reasonably small sized red candlestick, followed by a larger sized green candlestick. So that is a bullish engulfing. Now, depending on the market, if you're looking at a Forex market, then there will very rarely be a difference between the close of one candle and the open of another, because the Forex market is a 24-hour market. So you would rarely get this situation where the candle closes here and then opens in a different place. But of course, don't forget that we do have the wicks of the candles to consider as well. So in a Forex market, as long as the second candle is bigger than the first candle and engulfs the first candle, i.e. the low is lower and the high is higher, then we can call this a bullish engulfing. Usually at the very least though, we would want the lowest point of the bodies to be equal rather than higher. So we would want the lowest point of the bodies to be equal. So that's a bullish engulfing candle. Now what that means basically is prices come down. Prices come down. We have a seller candle, so prices, the bears are in control of this market, and then overwhelmingly at a certain point, the buyers take control of the market and push price up, and they manage to push price up higher than the high of the previous candle. So on a daily time frame, higher than the high of the previous day. And that is a very bullish signal and can mean that price is going to potentially continue upwards. So it's it can be a strong reversal pattern. Let's see if we can find a bullish engulfing candle. Let's have a look here. Let's see if we can find bullish engulfing candle. Okay, we've got one here. We've also got one just down here. So price has been coming down. Then we've got a small red candle, and then we've got a larger green candle, the high and the low of which engulf the previous candle. So it's bigger and it takes out both the high and the low of the previous candle. So that is an indication of a switch from selling pressure to buying pressure. The buyers have taken over this market, and it's an indication the price could continue upwards. Now, the opposite of this would be bearish engulfing. So bearish engulfing, we would have price coming from below, and then we would have a smaller green candle followed by a larger red candle, which takes out the we've got red, and green. So we've got a smaller green candle after a bullish run. We then have the sellers taking over and pushing price down to below the low of the previous day. So below the open of the previous day and below the low of the previous day. The sellers have taken over this market, and it can indicate the price is going to move further downwards. Bearish engulfing. There's one here. We do have a bit of a gap in this market, but that candle certainly is engulfing the entire of the previous candle there. Let's see if we can find a better example. We've got another one just here, bearish engulfing. So hopefully you get the picture. It is an indication of where price had been moving up with the buyers in control, a change in direction, a change in bias, sellers taking over the market and sellers pushing price down. Okay, so I've got a question here from Syed. If there is no support or resistance zone and then the bullish engulfing or bearish engulfing candle occurs, can we take an entry there? If you just bear with me, Syed, I am going to answer that question when I get to finding entries and exits. So at the moment, I'm just describing some candlestick patterns and how to recognize bullish and bearish candlestick patterns. I'm then going to build it into the bigger picture of how do we use those for our trading. So bear with me, we'll get to that in 5-10 minutes time. Another question, do we always identify candle patterns on the daily time frame? The answer to that is absolutely not. We can look at candlestick patterns on any time frame. So this here is the weekly time frame. I can look at this on the monthly time frame and still identify candlestick patterns. So here I have got a bearish candlestick, that's a shooting star. Bullish, that one is our dragonfly doji or hammer. Dragonfly doji because the open and the close are pretty much in the same place, but basically it's the same message, the same sentiment as a hammer. So absolutely we can look on the higher time frames, we can look on lower time frames. You know, I could put this onto a 1 hour chart and we can still very, very clearly identify candlestick patterns. There's a bearish one right there. Oh, that's the shooting star bearish. I'll see if I can find an engulfing. Oh, we've got a bullish one right there. So the answer is no, it doesn't have to always be on the daily time frame. Okay, so kind of similar but opposite to the engulfing pattern is what some people call a harami pattern or an inside bar. Harami, I believe, is a Japanese word meaning pregnancy. Anyone correct me if I'm wrong there. But it basically looks like, so the first candlestick in the pattern would be the larger one. So there we have the prices come up here. We've got a large green buyer candlestick, and we then have a smaller red bearish candlestick, and that can indicate a change of direction as well. So that is a bearish harami. Bullish harami would be price coming down, and then we see a smaller bullish candle indicating a potential move up. So the smaller candle is, the second candle is completely enclosed within the high and the low of the first candle. And then we have tweezer top and tweezer bottom. Let me see if I can think of where I saw an example recently of those. Let's have a look at the daily time frame on gold. Here we go. So a tweezer bottom is a candlestick pattern. Again, it's a 2 candlestick pattern, and it's basically where both of the candlesticks have the same or very similar low, and the candlesticks themselves tend to be a similar size, and that can indicate a change of direction as well. So we see here the tweezer bottom is a bullish signal, and that can then indicate that price may be about to rise. A tweezer top would be a bearish pattern, and it would indicate that price could be about to fall. So let me see if I can find a bearish one. Here, these are pretty good examples here. So these are 2 candle patterns, and the high of these candles are very, very similar, and they can indicate price moving downwards. We've got things like morning star and evening star. Those are 3 candle patterns, and as I said, I'm not here to teach you every single candle pattern there is. There just isn't time in a 1-hour webinar. A morning star is a bullish candlestick pattern. So with the bullish candlestick patterns, we are looking at price coming down, and then we're looking at a red first candle, and then it's a 3 candle pattern. So we would have a small second candle, and that candle can be green or red, and then we would have a larger third candle, and the second candle, the high and the low tend to be lower than the first candle and the third candle. So it shows a change in direction. Again, it's a bullish pattern. It shows that we had strong bearish price action with this strong seller candle, the first candle. The selling price action then is slowing down because the candle is much smaller. The sellers are not managing to push the price down much further, and then the buyers take over, and we have a strong buying candle, and that shows that the buyers have taken over and price is likely to continue to the upside. The opposite of that would be the evening star. So that would be price coming up. We have a strong first candle, bullish candle. We then have either color, green or red, doesn't matter too much, but a smaller second candle, that shows that the buyers are running out of steam. It's a small candle, it's not strongly directional. And then we have the third candle, which is a bearish candle, the high and low of which are lower than the second candle. And that shows a change in momentum from buying to selling is a bearish signal. So I think we will now, I think most of the questions, I'm trying to keep up with all of your questions, but please accept my apologies if I'm missing any questions. They're coming in thick and fast. The majority of them are about how do we trade with these candlestick patterns. So I will move on to that very, very shortly. Question, best time frame for candlesticks? I can't tell you the answer to that, to be honest with you. As I say, candlesticks can be used. Candlesticks are on any time frame. They display what has happened with price on any time frame. A 15-minute time frame, each candlestick would represent 15 minutes of time. A monthly time frame, each candlestick would tell you what has happened with price over that month. I can't tell you what the best time frame to look at candlesticks is. It would really depend on the strategy that you are using. It would depend on the time frame that you are trading. So, and that's a whole other question, because you know, different people have different personality types, different risk profiles, different availability during the day. Some people want to be full-time traders. Some people have a full-time job and can only trade you know, at the end of the day or the very beginning of the day. So really, there isn't a best time frame for candlesticks. It's about what is the best time frame for you to look at, given your personal circumstances, and that's not a question that I can answer. I can tell you what I personally trade. That you know, that may or may not help you. I personally, when I'm doing my market analysis, I look at the monthly and weekly time frames. Always, I never fail to look at the monthly and weekly time frames when I'm doing my analysis. My trades are usually on between the daily time frame and 15-minute time frame. So I will take trades on the daily time frame based around candlesticks, but you know, based on a strategy as well. And if I'm doing intraday trading, frequently on the 4-hourly and the hourly time frame, sometimes down to the 15-minute time frame as well. But again, it depends on the time that you have available. So let's have a look now at how we can use this candlestick analysis for our trading. So let's look at finding entries and exits for trades. Now, an hour, unfortunately, is just not long enough for me to teach you a whole strategy to do with trading. So I'm just going to try and give you a few ideas that hopefully you'll be able to use in your trading. So I'm going to go now to the euro dollar. I'm going to go to the euro dollar. Now, in order to look at how to use this with trading, I don't think I know any trader who uses candlesticks alone in trading. They are a very, very good indication of what has happened with price, what may happen next with price. But in order to build a strategy, we do need some other things. So I'm just going to come over to a chart where I have got a couple of moving averages on here. And again, I'm not going to have time to teach you a strategy. I've just picked out a 50 moving average, which is the red line, 20 moving average, which is the blue line, and 10 moving average, which is the black line. Now this is a weekly time frame of the euro dollar. Now with candlesticks, what they can do is give you an accurate place to enter a trade and an accurate place to place a stop loss on a trade, because risk management is key. Risk management is very, very important in trading. We must always trade using a stop loss if we are to conserve our capital. We need to look after the capital that we have. We don't want the market to turn around against us and for that loss to be indefinite. So the candlestick can give us a good place for a stop loss as well as a good place for an entry. But what I think is important is to have in mind, based on a strategy, whereabouts that entry needs to be. So some people may use moving averages as a guide. If price is trending, then it always must come back to its average at some point. That's by definition, an average of price has to come back to its average. And so a lot of people do use moving averages as just an area of equilibrium to show that price has moved away from and then back to. Now, in a downtrend, which this, from this point onwards, we do have a downtrend in price action, I would be looking for a selling opportunity. But I don't just want to find a bearish candlestick and trade based on that. I want my bearish candlestick to be in context. So the context that I have here is a horizontal level. Let me take it up to the monthly time frame, and you'll be able to see a little better where I have based this horizontal level on. We've got area of resistance around here. It's been support around here, support. So this horizontal level is based on a monthly time frame. We can see it fairly clearly on the weekly time frame. It's been support just recently. Now, what I would be looking for in terms of trading would be, I would be looking for a trend, by which I mean I would be looking for a lower high, and I would then need a lower low. So I would be looking for my horizontal level to break, giving me a lower low, which is what's happening around here. I've now got a lower low formed. And then I would be looking for price to come back, because I want my entry to be around this level, but I need my candlestick to give me a more accurate idea, a more accurate entry point, because price at this point could have come down, dipped below this level, and it could come all the way back up. Now, if I just pressed sell at the horizontal level, I would have lost my trade, I would have lost my money. So it's very important to use the candlesticks to make sure that we're getting an accurate entry. So what I would be looking for is price to come back to the level, but then I need to see my bearish candlestick. So this is a bearish engulfing candle, and it's around about my horizontal level that I have here. It's also around my 10 moving average, which is a zone of equilibrium. This area between the 10 and 20 moving average tends to be a zone of equilibrium where price in a trend will come back to. It will come back to its averages. So not only is this bearish engulfing candle at the horizontal level that I'm looking at the particular price I'm looking at, but it's also meeting the moving average equilibrium point as well. So what I would be looking at is potentially an entry at the bottom of the candle with a stop loss at the top of the candle. Now this is on a weekly time frame, so this gives a very large distance between the entry and the stop loss. More commonly, I will trade on a daily time frame or lower. However, once we have spotted this candlestick pattern, we can actually take that as an indication of direction. So for me, I would be bearish once I've spotted this particular pattern, and then I can go down to a lower time frame to see if I can find an entry on a lower time frame, which could also be based on candlesticks. Being asked to show examples on lower time frames, of course I will do. So let's look at dollar Swiss. Let's look at dollar Swiss. Dollar Swiss here, I've got dollar Swiss on a 4-hourly time frame, and this is a really nice example of trend. If I just flick up to the daily time frame, we'll just be able to see how nicely this price has been trending over the last few weeks. So we've got a really nice strong uptrend here. If we flick down to the 4-hour time frame, that is where my my entries can be more accurate and based on the candlesticks. So for example, if I was simply, and again, I'm not trying to teach you a strategy here, but if I was simply looking at an area of equilibrium to base my trades from, and just looking at this area in and around the 10 and 20 moving averages here, then I've got a hammer candlestick there. So that would be a bullish signal. So after price has come down, it's a signal that price may be about to return to the upside and move back up. There's another one here. So even if you were busy during the previous 4 hours, you often get another chance to take a trade later on. This one here, that is our bullish harami. So that is our small candle within the first candle larger, and then the smaller second candle within the high and low of the first candle, indicating, well, what it indicates is that the sellers have run out of steam here, and it's just a pause, a breathing in of the market before potentially the buyers come in force and push this back to the upside. I have got bullish engulfing right here. I've got another hammer here. I've got a tweezer bottom here, almost a tweezer bottom here, not quite, but not far off. So if I have analysed the trend correctly and picked out the direction, the overall market flow, which is up, then going down to a lower time frame and having an area where I'm looking for particular candlestick patterns to occur, i.e. this area between the 10 and 20 moving averages, then I can start to find actual entries for trades. And all of these entries I would base on the individual candlestick or candlesticks in the pattern. So for example, the hammer, I would tuck my stop loss below the low of the candle, and I would pop my entry above the high of the candle, and that means if price does take off to the upside, I will be triggered in, my trade will be entered, and I will be in this market to the upside. If the market continues downwards for whatever reason, I may not even be entered into the trade, and that will conserve my account by making my entry at the top of the candle. If it's a 2-bar pattern, I would stick my stop loss at the lowest point out of the 2 candles, and my entry at the high point of the 2 candles. So bullish engulfing, my stop loss would be at the lowest point of the 2 candles, likely to be the second candle, and my entry would be at the top of those 2 candles. Now, how does it help us identifying exits? Because of course, it's all well and good getting into a trade and picking the direction correctly, but if we don't exit the trade, then we don't bank the money. So we do need to know where to exit the trade as well. Now again, I use candlesticks in conjunction with other things usually, and that goes for my exits as well. So I will usually be using horizontal levels of support and resistance to indicate a potential suitable exit point. And if there is a candlestick pattern that coincides with that, so for example, if I were to have a horizontal level around here, and I were to see this candlestick pattern, which is a tweezer top, it's a strong bearish candle following a strong bullish candle, both of which have the high in a very similar place. Then I might consider, if I got into a trade down here, I might consider this to be a place to either take my profits or at the very least scale out of the trade and take partial profits, so that I am banking some cash along the way. So in the same way that I look for the candlestick patterns for entries, I will also look for the candlestick patterns for exits. It will more often than not be at a horizontal level of support and resistance. And again, that will depend on your strategy as to what you use as your horizontal levels. Some people might use pivots, some people draw horizontal levels based on higher time frames. You know, again, an hour is just not long enough for us to really thoroughly build a strategy, but hopefully you can go away and have a practice with spotting some of these candlestick patterns and using them with your strategy in order to improve your trading results. So let's have a look at another example. Let's have a look at dollar yen on the this is also on the 4-hourly time frame. And just seeing this little bit of trend here. I can notice some options for potential trade entries. This one here, it's a little bit like a morning star pattern. It's not the best example that I've seen of that, but a little bit like morning star. This one here is an engulfing candle, and these are all, if you notice, in my what I like to call the buy zone, the area in and around the 10 and the 20 moving averages. That's my buy zone, so that's where I like to look for potential trade entries. Over here, we can see more now. This, if I just go up a time frame, then this is building in another horizontal level here. We can see here this horizontal level of resistance where price has been trapped below this level for quite some significant amount of time. And then it's just broken through this level here. And so this is a daily time frame. I'm not finding my entry on the daily time frame. I've found my horizontal level on the daily time frame. This is a consolidation here over the period of a few months. Once I've got this horizontal level in mind, I can then go down a time frame. So I'm going down to the 4-hourly time frame. Let's just quickly find that area here, and then I can look for a break through that level and a pullback to the level, coinciding with those moving averages again. And here I have my my hammer candlestick. Over here, I've got my bullish harami, my what I like to call an inside candle. The second candle is smaller than the first candle, indicating a but it's a green candle indicating a move to the upside. I've got another hammer here, and yes, quite right, Alejandro. it would take a whole other webinar to go through chart patterns. And you've picked out, yes, that is an ascending triangle. I'm not going to cover chart patterns in this webinar, I just don't have time. But yes, it's a consolidation pattern in an ascending triangle which has broken, and I'm then looking for that move to the upside because of that consolidation pattern. So, question, can this strategy work on the 1 hour time frame? Absolutely yes. Let me go to the 1 hour time frame. Find that area of trend. Here's an area of trend on the 1 hour time frame, and let me see if I can find the same. Okay, so for example, I've got an area of consolidation here. Looking for that consolidation to break. It does break. Now, ideally, I would want to see a pullback and see a trade from the horizontal level. This doesn't give me the opportunity, but I do still have this bullish engulfing candle here, which is in the area of my buy zone. So that could be an option. There's a bullish engulfing candle here. Also could be an option for an entry. So really the candlesticks can be used on any time frame. I could go lower and lower down to the 15-minute. Can be used on any time frame. It's up to you to find a strategy that works for you in terms of where exactly you want your entries to be. But within that, we can use the candlesticks to nicely fine-tune the entries. So that is pretty much all that we've got time for. I have tried to get through as many of the questions as I possibly can. And I hope that some of the examples that I've used have illustrated how powerful candlestick patterns can be in indicating potential not only reversals in direction, but potentially continuations in direction as well, both of which can really benefit your trading. So let me just come back to the presentation just briefly. Okay, so just to give you, coming to the end of the webinar, the contact details for IC Markets. They have got a fantastic customer support team, which you can email. The email address is there, support@icmarkets.com. If you want to speak to someone on the phone, then absolutely, they do have a team at the end of the phone for you as well. The contact telephone number is there for you as well. And of course, they do have the usual socials, so Twitter, Facebook, Instagram. So you can, of course, follow them on there. So I really hope this webinar has been helpful for you. I really hope to have some of you back in a future webinar as well. Please do get in touch with customer service for any further questions that you do have. And with that, I wish you a fantastic evening, and I will speak to you all soon, no doubt.